We've had testimony from the regulators as well as the bankers involved in the March banking crisis that we had, and it would appear to me that the regulators are probably as much to blame as the banks. The banks had a model, all of them had business models outside the norm, and were allowed to continue that outside the norm business model by the regulators, who quite frankly admitted in front of us that they didn't do their job. So now it looks to me like we have the regulators say, well, don't ever let, the old adage of never let a crisis go to waste. It looks like we're sitting here now, the regulators, who should be, finding a way to clean up their own act, are now using this as a way to institute a Basel, which is, and to me, it's something we shouldn't be concerned about. But Mr. Baer, why is it a good idea to implement Basel III standards, which are European standards, on our American banks and our American banking industry? I see you chuckle because you're like me. This is nonsense.
Well, there is a notion that there should be international comity. That's ITY, not EDY, with respect to capital standards. So it's not a bad notion to go off and talk about it and try to get banks more or less around the world on.
Wouldn't it be a better idea for the European banks to actually follow our models, because we've got one of the biggest and best financial markets in the world, and then we want to turn it around and use a failed model of the European banks, which are all bankrupt and government takeovers basically at this point?
Yeah, I think the worst of this is that the agency staff, not even at the board level, went over and negotiated this, but then have again continually added it on and implemented it here in a way that's not fit for purpose. To me, the best example of that is whether it's operational risk, particularly market risk. While Basel was considering all of this, the Federal Reserve implemented a global market shock and a stress capital buffer to cover those risks. Then, over the years, they negotiated in Basel a second way to cover that. And every other country in the world, I believe, is going to implement the one in Basel, and we're going to implement both. So, in terms of holistic reviews, you can think about Basel as a good place to start, but that does not relieve the agencies of the obligation to document the risk weights, to prove, and maybe things have changed since 2017, to prove where they got the risk weights, why they think this is appropriate, and then to consider what else they're doing and how it relates.
Okay, Mr. Ullman, it would seem to me that by implementing this, it would send a message that their stress tests are inadequate to actually be able to do the job of predicting a problem, understanding how a situation could be resolved, understanding how strong a bank may be. If you're going to have to jump up the capital ratios here, it looks to me like it's a testimony to the fact that stress tests aren't working. How would you comment on that?
Yeah, one of the interesting things about the proposal is it doesn't reflect all the other work that's been done over more than a decade. Starting with Dodd-Frank, which I think at the time was sold as the kind of final chapter in bank regulation, and yet since then we've had a whole series of additional pile-ons on regulation. And so I think a common sense way to think about this is, when is enough enough? And is it the reaction to every time a bank fails, which happens in commerce, it's capitalism, that we go on and have another wholesale revision of capital requirements?
You mentioned the tailoring situation, and we've discussed it. The chairman discussed it. It would appear to me that if we're going to basically repeal S2155 and replace it with this one size fits all, that the small banks are going to be the losers in this. Would you comment on that?
I think that's one of the big concerns here, is that there's a remarkable diversity of institutions that are covered by this, and you're going to have a one size fits all approach to regulating them. That over time, the risk is we'll converge business models because that's easier to regulate. And losing that diversity in business models really does undermine the vitality of our banking system.
Thank you for that. Mr. Brooks-Smith, you made a comment that for every $1 million worth of capital increase, we lose $7 million of lending ability. And I think Mr. Barr mentioned that this is going to cost $67 billion in GDP per year. Have you got a cost of what it would be for the home mortgage market? What the cost is going to be to the consumers, to the banks, to the lenders?
The cost to consumers is that there'll be fewer sources of mortgage financing and that mortgage servicing rights, which this proposal caps at 10% instead of 25%, will go down in value, and that affects the price of every loan, regardless of whether it's made by a bank covered by this proposal or anyone.
And that's going to really hurt the low and moderate income folks who, because of the increased cost of a loan.
That's correct.
Gentleman's time has expired. The gentleman from California, Mr. Sherman, is recognized.